Great. So I'm going to continue. Last week I introduced credit risk, credit pricing, and we also introduced some credit models. The credit models that we introduced were mostly for default. Today I'm going to continue, but then we're going to introduce credit models for everything, because default is not only it's not the only risk factor that appears when we do credit. To review what we did last week and to get back into credit shape, I want to start with an exercise. This is an exercise from an exam. It's probably the PRM exam, although I'm not sure. And the exercise, what it says is, I'm giving you a transition probability matrix. I remind you what that is. You have some credit states, A, B, C, default. And every year, there's a probability you change from one state to the other. So we model credit quality as a Markov chain. This transition probability matrix tells us the probability that if in a given year, conditional on being on a certain state, the probability you move to another state is given by the elements in this matrix. That's what we saw last week. It's one of the things that we saw last week. And in this context, the question is calculate the cumulative probability of default for a counterparty in year 2 if its initial rating is B. Okay, so the probability of default in year 1 is very clear, it's 2%, we have it there. But what's the probability of default in 2 years?
You square the matrix?
You square the matrix, and what you do is you multiply that row and that column. In fact, you don't need to square the whole matrix. You only need one entry in the square, but that's exactly how you do it. So the answer is here. The default probability is 2% times the transition probability 2A, which is 0. It's the 93% probability times the 2% default probability of if you stay in B, and so on and so forth. It's that product. Okay? So the answer will be 5.78%. That's the answer. Yeah? Okay, great. So that's very good, and that's very simple. Now, what is the credit risk challenge? I want to pick up another thing that we did last week. We looked at the case of sovereign risk. We considered the probability that a country would default. I used the case of Greece because that was a very talked about event in 2015. Actually, even before that, 2012. And I remind you of a formula that we developed here. In this formula, we have a number of variables. V is the value of the debt, taking into account the fact that it could default with a certain probability. So there, implicitly, we have a default process, which is stochastic. We modeled it with a Markov chain last week, but maybe there's other ways to model that. And today, we in fact will see another way. It's not Markov. Well, it is Markovian, just not a Markov chain. So, but that was one source of uncertainty in dealing with credit. We dealt with that fairly extensively last week. Okay? But it's not the only one. How about that one? In the case of sovereign debt, or in case of a loan or a mortgage, the issue of the exposure was very simple last week. It was constant. Goodrich took a $50 million loan. Case of Greece, maybe $200 billion outstanding debt. That number was fixed. But in interesting credit applications, we want to consider the possibility of that number changing. So that introduces a new risk factor, which we will deal with today. And that risk factor is something which is linked to financial markets, not to counterparties. So the risk drivers for the default process and the risk drivers for the credit exposure, which we will define in a minute, are different. And then finally, we had, remember, the recovery rate. We argued that when a country defaults, they just don't pay. They actually give you some return on that. There's a term used in credit markets called a haircut, meaning if they owe you 100 million, they will say, are you happy with 70 million? And what are you going to say? So the 30 million that you lose is the haircut. That leads to the concept of a recovery rate, which is a stochastic term, and modeling that poses additional challenges. So just look at this formula here. It's a formula from last week. It's a very simple formula, a single cash flow, single counterparty, and there already we have three sources of risk that we need to model, and they're different. One is the recovery rate, one is the value of our portfolio that could change, and the other is the credit quality of our counterparty. The credit quality of the counterparty, I agree, is something we already saw. So I think we're well trained to deal with that. But how about the rest? How can we deal with all three risk factors at the same time? You understand the challenge? Okay, so we're going to be dealing with that today. And I'm going to be dealing with that starting with the first new element, which is the credit exposure. The default process is something we saw in great detail. I'm going to say a few things about that also today, but by and large, we spent last week dealing with that. Credit exposure, so what is it? The definition of credit exposure is the maximum credit loss that a portfolio can experience. So you have, think of the Goodrich swap. Do you remember that example, the Goodrich swap? There was a trust that had some credit exposure to Goodrich. If Goodrich does not pay, then they lose a series of cash flows. What's the size of those cash flows? We don't know. This was an 8-year loan for us, 8-year swap. During 8 years, many things could happen. I can pay you, you can pay me. We don't really know. It's not like in the case of a loan. So it's a stochastic object. The maximum of it is what we call credit exposure. Now, what's the maximum of a stochastic object? The maximum of a stochastic object into the future is probably infinity. If you are very rigorous about the definition of maximum, that may be infinity. So what we're going to do is we're going to first of all fix a point in time at which that maximum is observed, which could still be infinite, but now we're going to pick a certain level of confidence. So with a certain level of confidence, if the expectation of my random variable is finite, this would be a finite number. So this typically will be a finite number, okay? We pick a point in time, a year, 20 years, 100 years, and a confidence interval, 95%, 99%. It's a quantile over time, okay? That's what credit exposure is going to be for us. So what I have here is a picture, fairly realistic picture of what the credit exposure, how we build the credit exposure for the swap. So I want to explain this carefully. I want you to understand what's here. Let me start with the explanation of some variables. I chose here a value, which is a 5-year swap. I didn't do an 8-year, I did a 5-year. I think it was an 8-year for the Goodrich. Yes?
Just a question about the swaps in general. Like ever since the Goodrich one, is it sort of like standard practice that these things
Oh yeah.
take place?
Oh yeah. So swaps, good question. Let me spend some time talking about swaps. I'm not sure if so picture this, 70s, oil crisis, big oil crisis, inflation, interest rate volatility, the world was a mess, okay? You can compare to today, then that's your comparison. someone discovers that there is a way to alleviate or mitigate some of those risks through this agreement called a swap. I pay you, you pay me. What do you mean I pay you, you pay me? Well, every 6 months we see what this formula gives me, what this formula gives me, and you don't have to send me money and then send you money. We do the net, and then if I owe you more, you understand? Okay, so this was done in what's called an over-the-counter form. Over-the-counter means that we have a specific agreement and we check all the details and we agree, we sign, and then that thing exists and we deliver. Once you do a few of those, you decide you want to standardize those. So swaps became standardized in the 80s, giving rise to what's called an ISDA agreement, ISDA. Let me see if I remember what that is. International Standard for Derivative Agreement, or something like that. I don't know. It's something like that. It's close to that. Okay, you can check it. You can Google it. ISDA, ISDA. And that is a massive umbrella under which many financial transactions are done. Call options, put options, swaps. They're all ISDA agreements, which means that I can negotiate a swap agreement with you like this. Why? Because the ISDA agreement, all the 100 pages, takes care of all of the details. So we can do transactions very quickly. So the first swap probably took months to negotiate, right? Once you have the ISDA standard, then they take seconds to negotiate. Okay? So that's what happened in the 80s. And then the swap market grew into the billions and billions and billions. It's a good question, yeah. Okay, so I have here an example of the cash flows. These are the cash flows, possible cash flows of a swap, 5-year, $50 million notional, 11 fixed receiving, and Fed rates paying. Okay, remember, a swap was a difference between cash flows. Fixed, floating. So with this, and I consider semi-annual payments. So under that, this is what I'm doing. You'll understand this. This is done through some simulation. You can do this yourself. What's the value of the cash flows now? Well, now I know there's nothing. Swaps typically start at par, which means no cash flows. I don't pay you, you pay me, it's all good, right? Or maybe a small amount. But then, of course, as time goes by, I have uncertainty in the interest rates. The rates could move against me or in my favor. Because this is credit risk that I'm looking at, and these are, look at that here, 95%, 99%, what does that mean? This is my confidence interval. So at every point in time in the future, I have some uncertainty as to what the value of that portfolio will be. I'm modeling credit losses. If I'm modeling credit losses, what am I taking into account here? Situations where the swap works against me or in my favor. Remember that? Which one is it? Am I looking at the cash flows which are against me or in my favor for credit risk? I'm looking at the cash flows in my favor. If I was looking at market risk, it will be the opposite. Are the cash flows that I have to pay? But in credit risk, if I have to pay someone, I don't care if they default. I only care if they default when they have to pay me, right? So the cash flows which are relevant here are the ones which are incoming. And of course, I have uncertainty because I have no idea where the interest rates are going. I have no idea what these cash flows from this swap are generating. So all the possible, infinitely many cash flows I can get at a point in time, what I do is I look at the quantile of that cash flow random variable with the confidence interval, which is 95 or 99. 95 is in blue, 99 is in green. And this is the money I can lose. I will lose, if you look at that particular point in time where the arrow is pointing, if my counterparty defaults at that time, and at that time I happen to be hitting that, which I have a 95% chance of being, anywhere up to there, that's where I could lose. So that's my worst case scenario within 95% if my counterparty defaults there. That's what this means. Yes? As time goes by, let me continue with this and then I'll go back. As time goes by, note that every time after 6 months that I get a payment, the value of my exposure is going to come down. The outstanding amount is less. Sorry?
There is a transaction?
There is a transaction. Every 6 months is a transaction. I pay you, you pay me, we net it out, but the net effect of that is that the amount outstanding to be left through the life of the swap is now less. And obviously when I get to here, to the end, after 5 years, after 5 years my swap has a zero value. Sorry, I have to, okay, there we go. Every swap payment decreases the amount outstanding. So every 6 months I see a sudden drop. I say, woof, I got paid. Or maybe I didn't get paid, maybe I paid. Doesn't matter, it decreases the future risk that I have. Understand the concept here? So this is very interesting because there's nothing about credit here. Credit exposure is all about the value of the portfolio. I could have Apple as my counterparty, Goodrich, or your neighbor downstairs. It makes no difference. The 95 and the 99% numbers I have here reflect to the probability given by the market, not anything related to the credit quality of my counterparty. Is that clear? This is the most important thing I need you to understand about credit exposure. So credit exposure is really a curve that reflects what might happen to a stochastic process known as how much I can lose. If you default, when? I don't know, if you default. And then what we do is we look at the maximum value over time. So for the 99%, I look at the maximum number I can lose over time, which is that number over there. The maximum happens at exactly, month 21 or something, right? That's for the green, and for the blue is perhaps a different time, perhaps at the same. I don't know. Doesn't matter. So the credit exposure that you have on a deal, and a deal that could change up and down in its values, its future values, the credit exposure is the largest number you could lose. It's a worst case scenario. It's not an expectation. It's the worst case scenario. Yeah? Yeah.
What's the difference between this and value risk?
I cannot hear you.
What's the difference between this and value risk?
Okay. Value at risk is the largest value at same confidence interval at a point in time. This is through the entire history of my financial product. Okay, they're very similar. They're both quantiles. They're both expressed with a confidence interval. Value at risk is within a time frame. This is for the entire history. Okay, but they are very related, yes. Okay, that is credit exposure. And the most important thing to understand is that it's unrelated to my counterparty. In a certain sense, it has nothing to do with credit risk. If you want to relate it to credit risk, it would be within a confidence interval, assuming my counterparty defaults at the worst possible time, how much can I lose? That would be the definition of credit exposure using risk into account. So it's a worst case scenario of a worst case scenario. Double whammy. Understand? That's what the credit exposure is. All right. Now, The other thing that we need to model is recovery rate and loss given default. When default happens, there is a chance you can recover some of the losses. So the recovery rate is a number, it's a rate, so it's between 0 and 1, that represents the percentage value we expect to recover given default. But this number no one knows. Is it stochastic? Is it simply unknown? What is it? Well, it's somewhere in the middle. Somewhere in the middle. Now, loss given default is the opposite of that. The recovery rate and the loss given default are opposites of each other. They are both random variables, and the loss given default, which is what matters when I have a credit transaction, is 1 minus the recovery rate, or the recovery rate is 1 minus loss given default. We're going to initially, when credit was beginning to be actively traded in the 90s, there was no way of understanding what this number was to a great accuracy, and it was typically assumed to be constant for many years. When you were doing this, you just assume 50% because that's the industrial average. We're going to see these numbers now. But now the good models, what they do is they assume stochastic recovery, and we will have a model we'll develop today that will have the stochastic recovery built in for free. These are some statistics of two famous studies done a long time ago by Altman and others and Lieberman and others, and you have the numbers here. Perhaps what's most interesting in this table is to explain to you the terms that appear here. Seniority class, we briefly discussed it last week. I can tell you more today. When a company issues debt, they have to specify who gets paid first, who's first in line, who's second in line, who's third in line. First in line is always the government, taxes. You have to pay that, number one, okay? Second in line is typically the lawyers, liquidators, and stuff, the legal system, without which this will not happen. So when we say first to get paid, when we talk about senior secured, that's the first to get paid. It's really the third in line to get paid, okay? But, so senior secured, that will be the, again, first in line after government and liquidators to get paid. Then senior unsecured, then senior subordinated, then subordinated, and junior subordinated. And there's infinitely variations of this. And then there's mezzanine and lots of the terms. They're just designed to determine where in the line you are to collect what's yours. And the way this thing is collected is they get paid first until everything is gone. Only if there's things left, the senior unsecured will get paid. And only after assets are left, the next one will get paid, and so on and so on. So it's not that they share anything. You collect all of it. And if there's something left, that is for the next one who is in the lineup. That's how liquidation works. Yes? Clear? All right. So there was this study done, again, a long time ago, very small number of cases, sorry. Very small number of cases. And they give you the average and the standard deviation of the losses. These are percentage losses or losses on a $100 notional. So you can see 50 is about an average. All right, and that's why 50 is typically used. So we're not particularly interested in this. It's just to show you that this is how the topic of recovery was confronted years ago. Good. So with that, what's left to do now is to model the third element, which is the default process, which I already did last week. Today I want to introduce perhaps an enhancement of it or a variation of it, which is I'm going to consider the stochastic process, which is the default process. It's 0 when you're solvent and hits 1 when you default, and then it stays 1 forever. So it's a very simple process, just 0, then jumps, and then it stays there. That's the default process, and it measures the solvency or the default characteristics of your counterparty. The probability of default is nothing but now the conditional expectation of this process at a time t. We dealt with the probability of default and solvency extensively last week. This is the process that would be underlying what we did last week. But we're not going to spend too much time delving into this. So I can now tell you that the distribution of credit losses is defined as the product of these three stochastic processes. I have the credit exposure, it's a stochastic process. I have a certain observed value today, but it will change over time. The picture I show you for the swap, that's the picture we observed today. In 6 months, the picture will be different because rates will be at a different place, but also because there's less life left on the swap. Okay, so the graph that we gave is not a prediction of what the graph will be in 6 months. It will be a different graph. So it's a stochastic process. The default process is stochastic too. And the loss given default will be stochastic also. So the product of these three is what credit loss is. It's a very, very hard process to understand because the sources of uncertainty, the credit drivers are very diverse and they're very hard to understand. Okay? The first one depends exclusively on my counterparty. The next one depends exclusively on the portfolio and the market characteristics. And the third is almost a legal term. It depends on the what's called the capital structure of the firm. Is the definition of who you owe to and what is the priority of payment. All right? So there's something, there's a silver lining in the complexity of this, which is that this is a product of three things, three quantities, each of which is dependent on very specific credit drivers. The difficulty arises because we have to deal with three credit drivers that may have relationships between them or not. If they don't, things become very easy. But if they do, things can become quite complicated and interesting at the same time. I'll show you examples. And when you have different counterparties, the credit loss is just the sum of each of these complicated terms. Okay? So it's linear in the counterparties that I have. But it's highly nonlinear with each counterparty at a time. All right, so taking this into account, the credit loss distribution is often very complex. I have an example here for you. What we're going to do for most of this course is approach it like Markovitch approached portfolio theory 50 years ago, which we will see actually next week, I think, all right? Which is we're going to focus on the expected value and the standard deviation. The expected value is going to be called the expected loss, and the standard deviation is going to be called the unexpected loss. And this theory was like that for a long time, until the regulation BIS2, which I described to you 2 weeks ago. Then new quantities came up, and I'll define them today. So you can have a distribution which is typically like this. The credit loss distribution is not symmetric, because you only have losses, you don't have gains. And it is known to have very long tails. It takes a long time to get small. You have what's called, they're called left tail, although in this case they are to the right, okay, because I have losses, not gains. But it's something like that. And on this distribution, what we have is the expected loss is the average loss, which is something we understand very well. And the unexpected loss refers to the standard deviation. We will see different definitions of unexpected loss today, but the unexpected loss as the standard deviation is the first one that was used. We'll be very happy with that today. We're going to do a lot of things with the unexpected loss as the standard deviation today. Okay? So that's what that's going to be. Now, what happened in the BIS2 after the regulation was passed to take credit into account, a new object to measure unexpected loss was created, and it's called credit value at risk, credit VAR. And let me explain what these concepts are. First, I need to explain to you the concept of worst credit loss. Worst credit loss is the credit loss that we can determine will not be exceeded except with a very small probability, say 5% or 1%. Remember when we did value at risk? That was to your question, right? Value at risk was a quantile of losses I can experience. Worst credit loss is similar to that. It's how much money I can lose. Interestingly enough, credit value at risk is not the equivalent of value at risk. It's not the quantile. The quantile is the worst credit loss minus the expected loss. And this requires some explanation, which I will show you once I tell you a little bit more about regulation. I'll leave it for here now. I'll explain to you in the next slide when I explain to you how these things are put together. Just note that the credit value at risk is not the quantile that value at risk was. That's the worst credit loss. The credit value at risk is the difference between the quantile, the worst credit loss, and the expected loss. So if I have this picture, same as before, with my standard deviation and mean, the worst credit loss may be a number here, depends on your confidence interval, 99%, for example, right? And then the credit VAR will be the difference or the distance between the expected loss and the worst credit loss. It'll become clear once I explain to you how these things are regulated. Okay? Is this clear? This is heavy. I mean, there's a lot of things that go into this because we go into the quantile of a complicated distribution now. Okay? Well, today we're going to be doing calculations with things like this. So I think by the end of today, this should become at least manageable. I should tell you that, as is typical in this course, what I'm talking about today in other places is a course in itself. So I'm doing a massive exercise in information compression. I'll teach everything to you in 3 hours. It's a 3-hour course. I'll just touch on the points that I think you need to know, and the rest you can learn on your own. I prefer that you know the motivation and why things are important rather than the details. The details you can learn on your own. They're not that difficult. It's more difficult to understand the why. Why is this relevant than the actual detail, how you do things. Those massive formulas that you may see, those are easy. Understanding why those formulas are relevant, that's hard, and that's what I want you to understand. All right? So think of this way. When you have, imagine for a minute, let's get into, if you understand the business of credit or the business of risk, this will become easier to understand. So let me now try to bring you into a realistic commercial situation. Let's say you are an insurance company. Insurance companies, what do? They sell risk. That's what they do. They make money on risk. Say you are an insurance company and you are in the auto insurance business. You give people automobile insurance. Yes? Great. You charge for what? Why do you charge? What's the amount? What's the policy amount that you charge? It's linked to what? Is it linked to your expected losses? Obviously, your expected losses should be there. But is that the only thing you're charging for? If you only charge for the expected losses, something could happen, a hurricane somewhere, that there could be an event that just wipes you out, right? You can say, oh, well, this event happened, so you know what? I'll just wait another 100 years, right? And then with the policy income of the next 100 years, I'll be okay. No, you're going to die as a company, right? So you have to take into account the things that might happen that deviate from that expectation of income and claims that you have. How do you account for that? You have to understand what could happen and how bad could it be that I deviate from that expectation, right? Who comes from actuarial science here? No actuaries in this course? Oh, okay. Well, you should learn something about that, okay? One Sunday afternoon, you don't know what to do, become an actuary expert, and then that's it. You have to charge for things that might happen, which are not part of your expected. That is what we're trying to do here. And there's perhaps two ways of doing that. One way would be, well, I'm going to look at the standard deviation, that's what that is. And with the standard deviation, we know that if my distributions are Gaussian, then 2 standard deviations is about as far as I will go in terms of unexpected events, right? Okay, well, that's, as you know, in the case you have a normal distribution, a Gaussian distribution. How Gaussian does this look to you? It's not even symmetric, so it perhaps that's not the right approach. So perhaps the right approach is, okay, no, wait. If there is a way I can calculate quantiles, I'll go with the quantiles. The 2 standard deviations is really the quantile of the Gaussian, is the 99% quantile of the Gaussian. But if you're dealing with something no Gaussian, you better go to the quantile. That's why when you're going to regulate banks or insurance companies, a quantile is a much better measure of risk or measure of regulatory risk than a standard deviation. And that's why we pay attention to the credit VaR, right? So, but then you may say, wait a minute, but this is my loss. Who cares about that difference? If you're an insurance company, there's 2 elements here, the expected loss, which is how you price your premium, and the big loss you can have, which is what scares you. So the fact that we're looking at the credit VaR as the difference is not because we only care about the difference, is how we do risk accounting. The risk accounting of the expected loss and the risk accounting of the worst credit loss are different. This is built into my policy pricing. So I'm already fine. The expected loss I'm totally okay with because I'm already generating the income for that, right? So the only reason we're looking at credit VaR as opposed to the quantile, which is worst credit loss, is because credit VaR measures the deviation from the number I'm comfortable with. And that's the number I need to prepare for. I don't need to prepare for the entire worst credit loss because a good chunk of that is already taken care of by the policies that I sell. So for banks, it's the same. When you're into a risky trade, that risk needs to be broken into the risk that you already know you're going to incur, that's the expected loss, and the rest, the unknown, that's the unexpected loss. That's why credit VaR is used, not worst credit loss. But that's different when you're in market risk. That's where value at risk was the quantile, right? Because when you sell the financial product, that income is already there, you already have it. It's not something that is coming in the future, you already have it. So the reason, all of this makes sense from a risk accounting, which is something I'm just touching on the surface, and I'm letting you know that this is how things are done, all right? Now, perhaps it's more important if I give you, let me say something else, and then maybe I'll come back to this. So if I have a portfolio with a 95% worst credit loss, and I say that's 5 million, what does that mean? That means that there's a probability of less than 5% that I lose more than 5 million. Okay? The credit VaR of 5 million, what it means is that I can deviate 5 million from what I already expect I'm going to lose from a credit transaction. That's the difference between credit VaR and worst credit loss. And that's why for regulatory reasons, credit VaR is the difference, not the worst credit loss. That's going to come up in 2 examples I will do today. Okay, so let me just continue with this. And I want to give you a sense of how regulation works. I'm going to talk about regulation now for the next half an hour, maybe even more. It's very important. I told you yesterday that my coverage of credit, I'm going to blend together the trading aspects and the regulatory aspects because they are very hard to separate. Perhaps in my description of credit VaR and expected loss, you can begin to take a glimpse at how they can be split. Expected loss is trading related, whereas the other one is going to be regulatory related. But that's not a very clear-cut distinction because from a trading perspective, unless I have a massively diversified portfolio, those unlikely events can kill me. So I have to account for them. Even insurance companies, before they were regulated, they knew that a single accident, a single ship sinking, I'm talking about 4,000 years ago during Hammurabi, that this could kill you. So you have to add a premium for the extreme events. Okay? So that's really what we're talking about. So in the case of credit, expected losses lead to what's called credit reserves. Credit reserves is the capital that you put together for the losses that you know you're going to incur into. You're selling all these auto insurance policies, so claims come at a frequent rate, and you have those credit reserves so that when a claim comes, you can pay. Yes? But then you have to take into account the possibility of unexpected events, and that leads to what's called a regulatory capital. And the banks account for that differently. We will see an example of that today. We're going to do a credit trade today, and that I think will become very clear. Right? The worst credit loss measures the sum of capital and credit reserves, whereas credit VaR is the measure of capital. It should be clear now. Right? Expected loss is my credit reserves. So the regulatory capital is got to be credit VaR because worst credit loss contains both. Yes? Risk budgeting, that's what we're doing. In the case of credit reserves, losses come from defaults. In the case of regulatory capital, losses can come from defaults, but also from migrations, which is, I had a counterparty that I thought was good, now it's suddenly bad. So something that a deal I already entered, a swap I already entered, my credit counterparty, Rabobank, something happened to Rabobank. I wasn't accounting for that, so that goes into my regulatory capital because it was not in my credit reserves. Right? A credit migration is someone's downgraded, for example. That is what's called a migration. On the right, you have regulation. On the left, you have trading. It's still very hard to distinguish sometimes, but the philosophy is there. Clear? Okay, we're going to see an example of that. We're going to see a few examples today. My first, I'm going to move now to expected credit loss. In its most general sense, the expected credit loss is the expectation of my credit loss process, and this can be done at a point in time. I mean, I just wrote it, but this is very difficult to calculate, right? I mean, I need to know the full. It's very easy to write the E there, but then, yes?
Are there good measures to approximate it?
Yeah, we will see some, yeah. The approximations are going to be simulation-based. We're going to do some simulations today, and that's what people do, you simulate. Okay,
Like,
now,
I'm just thinking, like, at the very beginning of the course, you were talking about how basically we were taking, like, Taylor expansions.
Yes.
And only considering the first couple terms, which are, like,
Right.
observable.
Right.
And can you do something like that?
Yes, some people do that. You can, for example, something that, since you mentioned it, in the case of Gaussian distributions, these things are easy, right? Of course, oh, but this is not Gaussian. I know it's not Gaussian, but for example, something that people do, I don't think it works very well, but something that people do is, well, it's not a Gaussian, but the third moment and the fourth moment are something, right? So some people have done expansions based on the third and fourth moment. So, well, the third and fourth moment are not 0 and 3, then it will grow like that. And there's expansions for that. Usually they're not used. Especially the exposure is so complicated that the simulation approach is what people do. Okay, but there are some models that do that. Maybe they're useful sometimes. We'll see examples. We're going to do a lot of exercises in the class today. Yeah.
In general, I imagine this stuff is just so impossible to actually compute that you basically only have simulations, right?
Yes. Yeah. Yes. You only have simulations. The difficulty is in the simulations.
Sure.
Because in the examples it becomes clear. You can say, well, I simulate. Great. How? How do you simulate?
So is that the role of us?
Yes.
How to simulate?
Yes. Yeah. Because you say, oh, I'm going to simulate. I said, that's great. What's the distribution? I don't know. Well, if you don't know how you're going to simulate it, right? So a lot of the deep thinking goes into the simulation itself. We're going to see today there are two main difficulties in the simulation. First, understanding what the measure is that you're simulating. Because in particular, you can say, well, the credit exposure, I look at 100 years of history of fine. How do you simulate the LGD? Oh, and how do you simulate default if your counterparty has never defaulted? That's what we will do today, okay?
Like, so just for example, to simulate default, like, presumably you would make some sort of metric and compare it to other companies where you actually have that have or maybe haven't defaulted.
Well, okay, so yes, there's going to be some of that today. Yes, there's going to be some of that today. So today I'll give you a number of perspectives. None of them is going to be perfect, but by taking different perspectives into these complicated objects, you will generate, I think, an internal vision such that when something happens, you go, oh, well, maybe this works, maybe that works. I'll give you enough of a box of tools today. None of them is perfect. None of them solves everything. But at least you will get a sense of how you can do certain things. All of these things will come up in specific. There's going to be a lot of exercises today, a lot of exercises, each of which is aimed at understanding this from a certain perspective. Okay?
Where do the exercises exist in this class?
Here in the class. Oh yeah, I know in the class. In fact, I'm gonna ask you. I hope you have something to write on because I'm gonna ask you to do some things today. Okay? Yeah. You have to. Okay. So, for example, if the factors are independent, then of course this breaks into this, right? Which is not bad. At least this, that's the probability of default. That's the expected exposure, and that's the expected severity. The expected severity, I just look at the table we saw earlier. Okay, 50%. Probability of default, 2%. And expected exposure, look at my, yes.
So just, again, sorry, because I'm a math person, but could it be the case that this expected credit loss is infinity? Like we're taking the expectation of a random variable.
No, okay, yes. So, but remember that it could happen. It could happen if there are some distributions that have infinite first moments, and then, most of them don't. They have finite first moments, and in that case, this will be a finite number. Okay, so, okay, all right. So, so this is the first example I want you to do. First, I'm going to explain it to you. It's a very, very interesting example, very, very hard, but we're going to do a simplified version of it that we can actually do with pencil and paper in 2 lines. It's the case of a commercial mortgage. I'm going to consider a commercial mortgage, for example, a shopping mall as a collateral. I'm going to assume $100 million exposure. So you build a shopping mall, $100 million. And the thing with shopping malls, actually the thing with commercial mortgages, not residential. Residential mortgages are different. The thing with commercial mortgages is that in the case of default, what do you have as collateral? Well, in this case, the shopping mall, the building, the warehouse, whatever it is. In the case of default, what you get, it's known. what you get is of very bad quality. Why? Because companies, before they default, what they do to survive is they cut down maintenance, for example, right? You have a parking lot, and that's your collateral, right? And the company, well, they finally went bankrupt, and now, well, you have to go and you have to take the parking lot. You know what happens with parking lots? If you don't wash them, the salt eventually gets to the concrete, the rebar oxides, and the whole thing could collapse. So if you haven't washed that for 2 years, you may as well just tear it down. So that collateral that you think is worth something, it's not, because that parking lot is worthless, right? You get a shopping mall. It's been having financial difficulties for 2 years. They haven't done proper maintenance. There's leaks in the roof. No one cared. They didn't have money to. You understand what I'm saying? So this is very interesting that for commercial mortgages, this doesn't happen for residential. People take care of their homes. Where you live is different, but where you work, who cares? So it's known that when the credit quality of the counterparty degrades, the value of the collateral degrades too. And this increases the credit risk profile, right? Right? How much? Oh, that's a very active area of research. So today I'm going to do a baby model, very baby, okay, that helps us understand how that works. And I want to do it for you in front of your eyes so you can see that you can do this yourself. In fact, I'm going to ask you to do this. And this is, in a certain sense, it's rocket science. We're going to do rocket science with a very simple model because I want you to develop the intuition. I'm not going to claim that you're an expert on residential mortgages after you do this. No. But you're going to have some dexterity understanding certain things once we do this. You will see. So this is what I have here. I have a very simple problem for you. I could do this as an assignment. I prefer my assignments to be more interesting because this is a homework. This you just do. Okay, so this is something you could do in 5 minutes if I gave you 5 minutes here. I want to give you 1 minute of peace and tranquility so you can think about it and you tell me how you would do it. And then I'll do it for you. That's what I will do today. 1 minute, all right? So I want you to calculate the expected loss in 2 ways. First is assuming independence between recovery and default. We saw in the previous slide is the expected default times this, you just multiply. But we know that's not realistic. The reality is worse because there is a correlation between the quality of your collateral and the recovery rate. So I want you to calculate it assuming a minus 50% correlation between the default probability and the recovery rate, and you call that Y. For exercises, I love the 50% correlation because it gives rise to numbers that I know. You probably do too. It's not that this correlation is real. It's just that it's simple to calculate things with it, right? 0 and 100% correlation are very easy. 50% is, but you can do it. So this is what I want you to do. And I give you 4 choices, all right? I want you to determine of the 4 choices, which one is the one that you think. The first answer I give you is they're both the same. 10 million each and 10 million each. Or sorry, 10 million each, the same.
So
sorry?
Are A and B supposed to be guesses for both?
I'm giving you 4 choices. I'm only 4 choices, okay? Choice B is X is 10 and Y is 20. C is X is 10, Y is 5. And D is X is 10 and Y is 10.5. So this could be a quiz. If this was a quiz, what would you do? You don't know how to calculate it. What would you do? So no, we know those are probably not true. So you just increase your chances from 25% to 50%. You just think, right? we expect X to be lower than Y. That was the economic argument I gave you. So we don't think A and C are true. So it's got to be B or D. Which one do you think it is? Don't do anything. Just which one? What's your intuition telling you?
B.
You think B? Okay, then do it. I'll give you 1 minute. Think how you would do this. I'll give you 1 minute. Okay, minutes up. How will you do it? You know? Okay, this is how you think. There are two possible approaches. One is analytical, completely analytical. You can do this analytically. We just multiply the random variables. There's only two. The other one is constant, right? So if you multiply the two random variables and you calculate the expectation of the product, you can calculate that with the correlation.
How do you do that?
How you multiply random variables?
No, I know how to do that. How do you calculate the expected value of the product using the correlation?
Oh, it's equal to this standard deviation of each of them times the correlation.
Okay.
The expectation of the product
Sorry.
of two random variables is the product of the standard deviations times the correlation.
Okay.
If all three changed, no. Because then you have a cube. But if it's only two, you can do it, right? So in principle, you can do it with closed form solutions. But guess what? I'm not interested in closed form solutions today because they give you no intuition. So even there, we're going to do a simulation. And I'm going to simulate the two processes. I'm going to simulate the process with the characteristics given. So I'm going to consider that there are two equally likely future credit states given by default probabilities 30% and 10%, which averages to 20 with a 10% standard deviation as given. And I'm going to assume there are two equally likely future recovery states given by 60% and 40%, average of 50, 10% standard deviation as given. Okay? If I do that simulation, how does that work? So I have here an example that you probably already know. How do you calculate the joint probabilities of two correlated coins? So it's a Bernoulli variable with four possible outcomes, which I denote by two heads, two tails, head, tails, tails, head. Right? And then they have to satisfy these four equations. The first equation is the equation of correlation. That's what the correlation being minus 50% means. And the rest is that the marginals, like I said, they are equally likely events. So each of those is the marginal of a coin giving you heads or tails. That's how you would do it. You've done this in elementary probability. You know how to calculate the joint probability of two correlated coins, yes? Bernoulli for outcomes, yes?
Forget.
Well, you forgot. Well, okay, so forgetting is a different thing. So the solutions are here. 37.5% minus 50% correlation, so the probability of the up, down, up is more, 37.5%, and the aligned movements is less, 12.5%.
Sorry, I kind of understand. Why are you summing some and subtracting others in the first equation?
Oh, that's the correlation,
That's just the correlation.
right? Plus 1, plus 1, plus 1 minus 1, minus 1 plus 1, minus 1 times minus 1 is 1.
Oh, I see. Okay.
All right? I like the simulation approach because this simulation approach you can do anywhere. We're going to do it several times today.
It's also very similar to the 33% gain we talked about.
Perhaps.
Like this tree, you sort of
Perhaps, yep. Perhaps some people like to think of it that way. Yes, that's fine. Yeah. So this is the simulation approach. I calculate my events. There's only 4. I can do by hand. I don't need a computer for this. And then I calculate my losses under each of the 4 possible events. So that's what I do here. I give my, in the case of independence, I just multiply, that's easy, it's 10 million. And in the case of dependence, that's what I do. I have my 4 possible outcomes with probabilities. Answer is $10.5 million. That's the simulation approach. You can do analytic too, because I only have 2 random variables. The other one is not random, it's constant. And with 2, you multiply and you get an explicit formula using the correlation which is given. Understand what I'm saying? This is good. You can now do commercial mortgages. Sorry, you can do the credit profile of commercial mortgage. Well, not really. You understand how a commercial mortgage is going to be a little bit worse than a residential one because of this calculation. Of course, we made lots of assumptions. It doesn't matter. It's the concept. Yes? Is that clear? Good. Let me go to the next one. It's,
Just
yeah.
ask, so that the benefit of the simulation is that it seems to much more simply generalize to several different.
Well, there will be situations where that's all we can do. So, exactly. So it's easier to put into different contexts. So I'm going to consider the swap between the Goodrich and the Morgan Guarantee Trust. That's what we discussed yesterday. Today we're going to quantify it. We're going to assume a swap with a total exposure averaging $10 million with a 50% standard deviation, a default rate averaging 10% with a 3% standard deviation, and fixed recovery 50%. And as we discussed last week, we're going to consider, one is the obvious, is that they are independent, exposure and default are independent, but we already saw last week that that is not realistic. Realistic is there should be a negative correlation between default and exposure, because we saw that when the credit profile of Goodrich is worst is when the value of the exposure was less. We saw that last week. So let me quantify that and say that you have numbers X and Y. As before, X is the independent credit assessment. Y is the dependent credit assessment with a correlation of minus 50%. And I give you 4 answers. As before, 2 are obviously not, we expect YX to be bigger than Y, so this one and that one are just discarded. And you have to choose between those. And as before, the issue is how do you do this? You can do this also with a closed form expression, and you can do this with a simulation. In the closed form expression, you can do it because we're lucky. We only have 2 variables that matter, and when you multiply them, the correlation will solve it for you. The simulation is somehow more universal, so we will do it that way. And so as before, 2 approaches, the analytic approach, same as before, which I'm not going to do, and the simulation approach, which is this, also the same as before. Now I have to come up with a slightly different simulation framework. And here what I'm going to do is I'm going to consider 2 equally likely future credit states with probabilities of default 13 and 7, and 2 equally likely exposures with 15 and 5. They have the right parametric characteristics, so I go ahead with it. All right? That's my simulation approach. I have 4 events. And by the way, the probabilities are the same as before. I don't need to do the correlated coins anymore because I already did them. And then I just go for the solution. The independence approach is I just multiply the expected value of each variable. I get $500,000 of exposure. Expected loss. And in the dependence, I calculate my 4 possible events. They're all there. All the numbers are there. You don't have to look. The answer is $460,000. So yes, I see a decrease of the credit risk profile because of this economic quality of Goodrich, which is that when things are worse for them, my credit exposure goes down. It gets reflected in a decrease of the expected loss by 10%. 10% is not significant. The important thing is that you can now verify something that came up as a business discussion last week. That's the gain we have made now. Clear? Okay, and like this you can do many more. Okay, many more. I have more examples for here. This is an exam. It's an actual exam of the FRM, the Financial Risk Manager exam. Some of you may take it one day. This is from a long time ago, 1998. It says calculate the 1-year expected loss of a $100 million portfolio comprising 10 B-rated bonds. And they say the 1-year probability of default of each issuer is 6%, and the recovery rate of each issuer is 40%. And they ask you to calculate what is the expected loss. What's the answer? Everything is constant here.
So like, you can assume independence or something.
You don't have to, they're constant. So being in this exam question, the variables are constant. They are not, you don't have to consider. What I showed you is the general framework. It's very complicated, but beware, sometimes you're not in the general framework. You're in the simplest framework possible. Everything is constant, right? So don't be misled by my seemingly complicated approach to credit. Sometimes it's very easy. You just multiply. Everything is constant. The random variables are really not random. The answer is $3.6 million. The only difficulty here is to note that when you do this calculation, the recovery rate of 40% is not what you should use. You have to use loss given default. So in a certain sense, I like to see that this question is not a question on credit risk, it's a question on English. You just need to read it carefully, right? Yes?
The fact that you have 10 B-rated issuers, like, is that just a red herring? Like, it doesn't matter how many you had?
It wouldn't matter. It wouldn't matter. It's the expected, and everything is constant. You have 10 random variables, they're not really random. Well, the randomness only comes from the probability of default. That's the one. That's what I take into account here. So it's not that I have 2 random variables like in my previous example. Here I have only one. It's the default event. That's the only one which is random. The other 2 variables are constant. You understand what I'm saying? This is not so hard, eh? All right, you can also write that this is $360,000 expected loss per bond, or 3.6% of the notional value. Different ways of saying the same thing. Okay? Clear? Do you notice how we are climbing a hill very steadily, and now you start to be in charge of your, like, do you get a sense that you're beginning to own the space a little bit with these examples? Yes? Do you get that sense of ownership? No? No, you don't get that sense of ownership? No? You don't get it? Okay, what's missing?
A couple more times maybe.
Yeah? Okay. Okay.
Yeah, I get the sense it could be.
Yeah. Yeah. We are covering a lot of ground very, very quickly. We are, okay? It's a steady climb because we're very well prepared. We've learned lots of things, but we're covering a lot of ground. Today we're going to cover a lot of ground. Okay. So let's see. I have a little bit of a steady climb because I have my own version of this question, which I like more. And it's not about the expected loss, it's about the unexpected loss. So calculate the same thing. Sorry, not the same thing. In the same situation with the same bonds, calculate the 1-year unexpected loss, $100 million portfolio, 10 B-rated bonds, 1-year probability of default, 6%, recovery rate for the same as before, But now I want you to do the unexpected loss, the standard deviation. And I give you three variants. Variant one is that all bonds are the same issuer. Variant two, correlation is 0%, means that they are completely independent. And third is they are 50% correlated. In other words, they are like in the same sector, same country, same something. They share something. Well, how will you do this? Again, think. Unexpected loss, standard deviation. Just think. The reason I want you to think is so that you can catch up, okay? I don't want to lose you in this climb that we're doing. Let me do it. It's very simple. Let me do A. A is the easiest. They're all the same issuer, so whether it's one bond or 10 bonds, it wouldn't matter, right? So what I do is really two events that could happen. Default, loss of 60 million. No default, loss of 0. And we know the probabilities of that. So we just need to, expectation is 3.6 million, we saw that earlier. So we just calculate the variance as that. Huh?
Nothing, just million squares of 1 unit.
Yeah, well, I give you some advice, is always keep track of the units. The units will help you. You know, take care of your units and your units will take care of you. And I do this on purpose, yes. So, because when you see that, you clearly know that this is not the number that is being asked. They are being asked for the square root. So you have to take the square root of that, okay? 14 million. I always like to track my units, always. It's a good advice. Prevents many errors from happening. Yes? Maybe you're lost a little bit, maybe you're a little lost, but you see that this is like no problem, right? You've done this. If I write this, I can do exactly the same problem without mentioning bonds and just give you random variables. It'll be like sure, I did it when I was a little kid, yes? So why is it more difficult that I attach the meaning to a bond and stuff? It's the same. Perhaps these are also questions on your command of English more than your command of mathematical finance, no? Perhaps. Yes? That's easy. Okay, so that's, how about B? B is when they were 0% correlated. So now I have 10, they're uncorrelated. For each of them, I have a default loss or a no loss. And I have 10 of them. The expectation loss of each of them is 260,000. And the standard deviation of each of them is 1.4 million as before. And I have 10 of them, they're uncorrelated, so I know what the answer is. It's just that. They're uncorrelated, so they grow by the square root of 10, not by 10. 10 is if they were 100% correlated. Yes? Also easy, right? Yeah? Good. And the last one is when they say 50% correlation. I have 10 of such events, and now give them a name because I have to write down a formula. So each of these random variables, which represents losses, is xi. Each of it, same thing, they can default and lose 6 million each or nothing. We know the probabilities, we know the expectations, we know the standard deviations, and when we put them together, We just need to calculate the variance of the sum of random variables, which is right there. I separate the diagonal and off diagonal. The diagonal I already calculated in part A is the same. And this one I already have, that covariance is the correlation times the standard deviation, which I also know from part A. I calculate, the answer is $110 squared. So it's the square root of that. That's what I'm looking for. Yes, are we good? And then I think this is my last one. It's a question. This is really, it says, ask, which loan is more risky? You have the obligors are rated the same, they are from the same industry and have more or less the same sized idiosyncratic risk. What is idiosyncratic risk? I haven't said anything about that. What is it? That's the risk of each specific counterparty that they may be in the same rating system, but they're slightly different. That's what it means. It's actually not very relevant for this question, but that's what it means, right? And then they give you 4 loans. The first loan has $1 million. It's a loan of $1 million with a 50% recovery rate. The next one is $1 million with no collateral. The next one is $4 million with 40% recovery rate. And the last one is $4 million with a 60% recovery rate. What do you think is the riskiest of these loans? Yes. If you look at the loss of each of them, $500,000, next is 1 million, this is 2.4, and again you have to be careful that the recovery is not what you use, is 1 minus the recovery, the loss given default, and the last one is 1.6. Yes. So that's the riskiest. Okay, FRM exam 1999. Yes? Great. Okay. So now what I'm going to do, and I will do this before, we'll do this and then we'll take a break. Okay. This is the climax of this whole thing. We're going to do a credit trade now. I think we're ready. Okay. To do this trade, I need 2 volunteers who want to trade with me. Hopefully in the room. In Zoom is more difficult. So, do I have 2 volunteers in the room to trade with me? You guys will never get a job, okay? You will get a job, yes. And you guys will get a job. The rest of you'll be unemployed forever, okay? If someone offers you a job, you raise your hand. That's what you do, okay? That's the best.
I thought we were done the working for free portion of the course.
Yeah, we're done, exactly. Now we work, you are about to get paid. You're about to get paid. We'll figure out the currency, but you're about to get paid, yes. Okay. The best advice I can give you in this course is someone offers you a job, you take it. Maybe for a minute, okay? And say, no, I don't want it. All right, so we'll trade. And in this trade, I have to tell you, there's going to be a bond that you can buy. It's a defaultable bond. It's a credit trade. And what is going to make the two of you different and what will allow you to compete or not is who you work for. So I want to say you work for a bank. You work for a hedge fund. We haven't explained what a hedge fund is, but I'll explain today. We're going to do a lot of this next week, okay? So I think it's good preparation for next week. You're a bank, you're a hedge fund, okay? And there's a bond available for trade here. And we're going to, I'm going to create a bond and you guys are going to bid for it. Bid, you know what bid means? Bid. You have some money, you say, I want to invest this money buying this bond. I think I can make some money, right? That's what you will do. Yes? Okay, so get ready for the bond trade. Yes, we're all ready? They're trading, but you are, what are you doing here? You're watching maybe? I don't know. What's your role in this?
They're the trust, right?
What?
They're the trust.
They say trust, maybe they're your bosses. Maybe they will fire you if you do the wrong trade, right? Or you're managing their money and say, I'll give the money to my hedge fund, not to the bank, or vice versa, you know? Okay? Maybe these are your clients or your bosses. We don't. Clients and bosses are almost the same thing, right? Okay, so everybody watch. We're going to do a trade. All right? So the trade is a very simple trade. I'm going to consider a bond issued by, say, me, doesn't matter. It has two $5 coupon payments, that's it, in years 2 and 4. That's it. I'll give you $5 in 2 years and $5 in 2 years. That's my bond. Zero principal, and just two coupon payments. Yes, very simple. I have a probability of default of 7% per year. And there's some assumptions. I'm going to assume that, so you guys will be the ones buying this. You'll decide how much you have to pay, all right? And you will have to maintain some risk capital to cover the losses. So it's a credit trade. And what I'm saying here is that in the credit trade, you have to not only take into account the expected loss, that will be very easy. You have to take into account the unexpected loss too. That's what I'm saying here. I'll tell you exactly how this translates into numbers when we get to that. And the amount of a regulatory capital will be adjusted annually. Not relevant now. I want to tell you about this bond, okay? And also, it's going to demand a certain return on the risk capital. I'll explain this once we get into the trade. Once you start bidding for it, I'll explain to you what will happen with your money after you bid for my bond. I'll explain to you later. This is a real trade. Very simple. But all the considerations that go into a trade, you're going to see here. And you're going to see that doing a credit trade or a market trade is very different. If you are buying a call option, it will be very, very different. Okay? All right, let's get used to that. Here's some numbers that you can do. This is the default tree. What I have is probability of no default and probability of default on each of the years. There's 4 years. Probability that I default in year 1 is 7%. Probability that I don't default is 93%. Probability that I default in year 2 is 7% times 93%, which is 6.5%, right? And so on and so forth. These numbers you can do. I'll be using them when I need to. I will not make a reference. I will say, oh, this number is here. Look, you already understand this. Yes, yes, you can do this. And the solvency probabilities, for me, I'm issuing the bond, is 93% for year 1, 86.5% for year 2, 80% for year 3, and 75% year 4. These numbers are calculated, they are there, you have them on your spreadsheet, you're good. Yeah? All right. So I'm going to calculate the expected loss. We know that this is not the only thing we have to calculate. We also need to calculate the unexpected loss. I said it earlier. And you will see that when you're trading, you need to do that. We explained it earlier with the case of the insurance company, and now it's going to become very, very clear. So the first method is the simplest one, very easy. I have two $5 coupon payments. So the expected value is the formula that we saw last week. It's 5 times the probability that I'm solvent in the first 2 years, plus $5 times the probability I'm solvent for the first 4 years, which is smaller. The answer is $8.06.5. I do this calculation for you. You can do it. You know how to do Excel. Yeah, you can do this. That's the expected cash flow. $8.06.5. There is, well, this is the probability that I stay solvent during those years, all clear. And the expected loss is $1.93.5. $10 minus that. This is the analytics, okay? So you guys are doing this in your spreadsheets. You are somewhere in Bay Street, you're somewhere in Davisville. That's where hedge funds are, in Toronto, okay? Brookfield Place sometimes. Okay. You've done this, you have this on your computer, and you're both looking at the same number. And you guys are watching, and you got the same number too. So these guys know what they're doing. Yeah? Now, it's interesting, there's another way of doing that, which is you can calculate the exposures per year. The exposure in year 1 is $10, that's all you can lose, right? $10, and then of course, after I make my $5 coupon payment, it drops to 5. And it so happens that you can calculate the expected loss also with a different formula, which is by calculating the exposures in each year, multiplying by the probability of default in that year. I'm not going to get into why this miracle is happening, okay? But the number is exactly the same.
But it's not a coincidence.
It's not a coincidence, no, it is integration by parts. Yeah, but it doesn't matter, I'm not important, not interested. You probably like this better. Fine, you take that method, no problem. Yeah? Great. Ready? Yeah? Okay. So maybe I'll ask you, well, maybe this is not your final bid, okay? But do you have a bid? How much would you bid for this bond now? Both of you. Don't wait for the other to just say a number, you know. What? How much? I cannot hear you.
$6.
You bid $6. Oh yeah, you're aggressive. Yeah. Okay. How about you?
I don't know, like $7.
$7. I think the bond is going to be yours. Okay. So for now, okay, we'll see. Okay. He's bidding 7. He's bidding 6. For now. For now, right? What if he gets it for 7? Is that a good deal? You guys are watching. Is that a good deal? He gets to make $1, right? He's bidding 7. He's expected to make $1.06.5. For a $7 bid, that looks pretty good, right? And how about him? What's he sleep at the wheel? Are you going to change your bid?
There might be unexpected losses.
What?
There might be unexpected losses.
There could be unexpected. We're going to go there. So he's watching. Okay, this guy's waiting for, he's working on his Excel calculation for the unexpected loss. We'll see. Let's do the unexpected loss and let's see what happens. Are you guys following? You're following the trade? It's very easy. Yeah?
So just in particular, like if you didn't think about the unexpected losses, then for instance, $7 would be a good bid.
It will be great. It will be, well, okay. I will give you the full answer in about 10 minutes. But I would say this is great. If you do this for a living, you do a trade like this every minute. The law of large numbers says, who cares about unexpected losses? I'm going to convert to my expected losses very, very quickly, blah, 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 blah. You're making $1. My God, you make $1 a minute? Not bad, right? Especially it's probably not, I mean, maybe it's $1 million. Maybe it's $1 million a minute. Now it's even better, right? And now you guys want to work for him. You can do his Excel and bring him coffee. Yes? Maybe? Okay. Are we, yes? Are you into the game? Yeah, you all into the game? Anybody say, what are you talking about? Anybody's like that? No? You all into the game? Great. Okay, so let me get the game started, because this is the thing that really matters. You will see. Unexpected losses. What I have here for you is a very complicated calculation. Yeah, don't even read, okay? It's the calculation of the standard deviation of losses year by year, which is done in your Excel. I did it for you. Okay? And these are the variances. So for the first year, the variance is $6.50 squared. Next year is $6.08 squared. Next year is $1.42 squared. Here I have the standard deviation. They're easier to understand, and they're in dollars, right? Year 1, the standard deviation is $2.55. Year 2 is $2.46. Year 3 is $1.19. I already received a $5 coupon payment in year 3, right? And then year 4 is 1.15. So with this table of standard deviation, would you revise your bid? 6, 7. Perhaps I didn't give you enough information to revise your bid, because you're thinking, oh, what does that mean? What does the standard deviation mean, right? I mean, you know what it means, but what does it mean in the context of the trade? So let me help you. Let me help you. This is very important. This is perhaps the most important thing we're learning today. Okay? How the standard deviation enters into this trade and into the bid that you will do. Are you with me? Drum roll? Okay. So let's go back to credit reserves and economic capital. Remember that? Remember that? So in our example, what is the $1.90 something cents? What is that? That's what you stand to lose. That is what we called credit reserves, right? And the question was, what's the what's the regulatory capital I need to have because something might happen, right? Okay, so what I have here is, I'm going to assume you're a bank. That means a bank is regulated. The Bank of Canada is watching everything you do, right? And in your case, when you do this trade, the Bank of Canada says, you're taking risk. And you say, yes, sir. Yes, ma'am. That's what I do. I'm a bank. I take risks. Banks take risks? Yeah, they do when they give you a loan, right? Yeah, that's what I do. So that's great. Go ahead, take risks, but you have to give me 2 times your standard deviation in dollars per year as collateral. I mean, you can do your own collateral for the bond. This bond has no collateral, right? But when banks take risks, they're regulated by the central bank or the Fed or wherever you are. And they have to say, well, I'm taking this risk, so this amount of assets I have to keep with the central bank as regulatory capital. That's what regulatory capital is. Every time you take risk, you have to keep some regulatory capital with the bank. Insurance companies have the same with their insurance regulator. Understand what I'm saying? Yes?
You can, so that amount of money kept by the bank is, you can get them until the end of the transaction.
Yes. When the risk goes, you get money back. So it's not that this bond has now matured. Here you go. No, it doesn't work like that. Every day, every month, you do a risk calculation that shows how much risk the whole institution has, right? And that risk is a combination of the bonds that you have which have not matured, where markets are, what's happening with this, what's happening with that. It's a very complicated calculation done every day. And as a function of that, you decide how much money goes to the central bank every day. So here I'm giving you a caricature of a bank that has a single instrument in it, and it's done by you. You are the only trader in that bank, and you do a single trade, and you're doing only this bond. And then the regulator is going to say, you're taking a certain standard deviation of risk. So 2 times that, I'm going to freeze from your account. That's going to go to me. And of course, as the risk changes, you get it back. But I want you to understand the mechanism. The mechanism is you calculate every day. Suddenly that bond is gone, so the risk is gone. So you have too much capital with me. Here you go. Or you don't have enough. Give me some. Yes.
So just for the example before, like you gave this table with the standard deviations.
Yeah.
So if I want to offer $7 for the bond,
Yeah.
I then have to give the Bank of Canada twice what the standard deviation is.
Right.
So my bid is like what I'm actually paying is like, I guess the first number was like 2.5.
Right. Exactly. Yeah.
The amount of money on the day I buy the bond,
Right.
7 plus would be 12.
Correct. It's going to cost you a lot of money. You have to put like $2.50 with the Bank of. You're going to get it back in 4 years.
But would I? So in this, but you have 4 different numbers. So after year 1, like you say, the standard deviation changes. So would they give me back?
Yes.
My 250, and then I'll
Yes.
give them
Yes.
25 or whatever it was. Times 2.
No. They just give it back to you. Sorry.
I guess they just give you the difference back between you.
Right. This would be yes. So they give you your difference back exactly. So they adjust that number every day, right? So it looks like you're taking some more risk today. Give me $5 million more today. Oh, it looks like your risk is going down. Here you go, $10 million today. Every day you adjust your risk balance with the central bank. Okay?
Do they make money on holding that?
Who?
The central bank?
No, they pay you for that. No, they don't.
I know they. Well, I guess they set the interest rates.
Yeah, I'm assuming here 0% interest rates. Otherwise, that money that you give, you'll get it back. Yeah. So this is not done as a way for the central bank. The central bank has other ways of making money. This is not one of them. It's clear? Okay, so in doing this trade, we understand regulation too. But the word regulation applies to you, not to you. Okay? Clear? Great. Okay, perfect. So if that's the case, then in year 1, you have to send $5 to the central bank. When you do the trade, so you pay 7, and now you send 5 to the central bank, right? After a year, you said, oh, here you go. Now you get 17 cents back. And then in year 3, oh, now you get $2.50 back. And then you get a few cents back, and then after year 4, say, well, here's your money back. Because at that point, the risk has disappeared. That's how regulation and regulatory capital works. All clear? All clear? Great. But that's you. You're a bank. You're a hedge fund. So what do? You laugh. You say, I don't have any of that. Okay, maybe some of your investors are here. You think your investors want you to send money somewhere? No. The way you manage risk is different. The reason is that banks have what's called systemic risk. When a bank blows up, as it happens every once in a while, it's a disaster, right? Lehman Brothers blew up in 08, that was a mess. Silicon Valley Bank blew up, didn't seem that it was that big a deal, right? But it's bad when a bank blows up. When a hedge fund blows up, what is a hedge fund? It's an investment fund. Their investors are sad and teary and this and that, but that's it. The system is not sensitive to that. Exception was long-term capital management, 1988. We'll talk about that in 2 weeks. And then you'll see. So in 2 weeks, you'll remember this example. Okay? We are understanding how regulation works. And by the way, this is why most of you, if you work in the financial sector, you work in a bank or an insurance company. Probably not so much in a hedge fund, because hedge funds don't have to do this. They will do something different, but not this. And a lot of the jobs in the banks are to do this every day. So this thing that you're seeing here is a good caricature of what's happening in the risk management departments in the banks. By the way, in the trading departments too, just from the other side of the equation. It's all clear? Now, there's something else here, which is, I say, when you have to send that money you're going to get it back, and they'll pay you interest on that. But guess what? You work for a commercial entity called a bank. And in a bank, money is not free. People think that money is not free. So you have what's called a P&L. You have a certain account with a certain balance in it. The bank will demand that you have a certain return on that money every year before they consider giving you a bonus or before they consider that you actually made profits. That amount is something like 5%. I chose 10 today because it's easier to multiply by 10. It's a bit high, okay? Usually it's 5. So when you say that you're going to have to send $5 million to Ottawa, that has an immediate hit in your P&L. According to this, you're going to lose on that year, even if you get it back after a year, that's going to cost you real money. It's going to cost you 51 cents. Real money. Because the bank looks at your balance when, it was for regulatory capital. I don't care. So the money you use for whatever it is, to do a bond trade or to send regulatory capital, it has a cost of 10%. The number is 5. Okay? 7, 3, depends on your job. For you, cost is 0. You don't have to send anything, right? Your cost of capital is different because you are a different type of a commercial entity. You're not regulated. You have investors who say, you didn't give me 10% this year, man. So they get very upset and they take the money somewhere else. So for you, there's another cost of capital, but it's not regulatory like this one. It's different. We will see this next week. This is what we'll do next week, by the way. All right? Good. So that means that if I go with the 10% number, your actual cost, is going to be $1.47. That is your cost of the unexpected loss. That's your cost of the regulatory capital. Yes?
Sorry, Commissioner. Who's keeping the 10%? Is it the Bank of Canada?
No, that's his employer, the bank, Royal Bank, or whoever he's working at. Because when he's using money from the bank will demand a return on that before his bonuses. So it's going to have a real cost. It's like money you're borrowing. The money that is given to you is money which is really borrowed, and the bank will charge you a high interest rate on that money lent to you. When you're trading, if you stay at 5, you're just paying the interest on the money given to you.
So even if I work for the bank, I'm paying the bank.
Yes, you are.
That's bad.
Yes. I mean, you not your salary, but I mean your P&L, the bank will charge you money on that P&L. That money is not for free. I like this example because you learn how regulation works and you learn how trading works in one example. It's an exaggeration. Don't go there and say, oh, I heard this. No, it's an exaggeration, all right? It's a slight exaggeration, but when you go and work in a bank, learn that this is how it works. When you go to an insurance company, very similar too. When you do a credit calculation or a risk calculation at a bank or insurance company, someone is paying for that. Yes.
So now, if we were to figure out how much I should have bid, I would have to take this number into
That's my point.
So my expected loss would be the expected loss I calculated plus the for sure loss.
Exactly. So you're going to lose your expected loss, $1, $2, plus that. So you're not going to be able to bid more than 6.5 cents. You're not.
Otherwise, I lose money just because of this number.
If you bid 6.7, you're losing money. Even if there is no default, you're losing money. Your regulatory environment will make you less competitive. That's what regulatory environments do. They make you less competitive. And that's the reason, by the way, that central banks don't want to be extremely conservative on their regulation, because then their banks are not going to make any money. And then all the money will be made by the US banks or the Australian banks, or that's how countries compete with each other, the banking system, right? But you don't want your banks to go belly up either. We're not talking about the decision of the regulator. We're talking about the banks and the hedge funds right now, right? If we took their side of the story, there would be a different calculation. But you understand it too now. Because now, I mean, maybe I have a third person bidding here. Who wants to bid here? A third person? Someone, say that you work for a US bank where they only require that you 5% there, let's say. Then you have a real competition here, right? Right? And guess what? You're in a hedge fund. You used to work at Royal Bank before. You know exactly how much he's being charged for this. That's where you bet 6, because he knows he cannot match it, right? And now your investors are very happy. I said, yeah, damn, this guy, he's worth the big bucks. We pay him. Yes? You understand? That's how it works. I told you, starting reading week, no one works for free anymore. And there's no better example than that, than this. Yeah? Okay, good. We've climbed this nice hill. We're going to stay here for 10 minutes. Okay, we take a break. Enjoy the view. We've gone a long way. We've learned a lot of things on this, 2-hour climb. We have, all right? 10-minute break. When we come back, I'll tell you about 2 commercial models, and that'll be the end of credit for us. So 10 minutes. So I'm going to now switch to talk about 2 commercial models that exist. The first is a model called credit matrix. There's some history to that. I mentioned that 2 weeks ago, created, I think, by JP Morgan in the 1996 or 7 or something like that. It evolved after that. I want to mention a rather old version of it, because that's all I want you to know. It is a model which is, oh yes, sorry, before I start, there were some 2 good questions during the break that I said ask me after the break. So sorry, questions. You had a question, yes.
So for the auction, if bank has to pay for the actual component for their the bid price, then the bond always goes to the hedge fund. Then what's the point of them joining this auction?
I couldn't. You have to speak up more.
Okay, so for each of the option to bind this bonds, then the bank always has to pay some extra money for the
Yes.
bonds that's the
Right.
business. Then why the bank has to join this option, because at the end the bonds always go to the account.
Okay, so typically, yeah. So this is banks are less competitive than, for example, in this case, hedge funds, right? The advantage banks would have is banks may have appetite for risks that hedge funds don't. For example, I may prefer to trade with a bank who I trust, and because of that, I'm willing to give up a spread. Imagine a mortgage. Imagine that this is not a bond, it's a mortgage, right? So a bank would give me a mortgage which has a rate higher than what I could get if I deal directly with a hedge fund, right? But a hedge fund does not care about my puny $1 million mortgage. The bank does. They have branches, and so that's why in practice, a lot of these trades, they go through banks because the banks are in the retail business. He would love to have my mortgage if it was $100 million mortgage. For $1 million mortgage, it's not worth his time. So go to a bank. You understand the similarities that I'm doing? For that particular bond, yeah, the hedge fund would win. But if it's a very small trade, the hedge fund doesn't care. I go to the bank, right? The bank would charge me money for that. There is something in the chat. Those of you who write in the chat, I cannot check the chat while I'm lecturing, okay? This is for the people on... Oh, no. I'm muted. They couldn't hear me. That's where it was. Yes, I was muted. Yeah, okay. So the business aspect of this is that the banks capture a lot of these deals just because they are not attractive enough for the big hedge fund managers that want bigger deals. Okay, that's why in practice the banks win for small deals. But what do the banks do? Once they get this, they sell the bond to the hedge fund, right? Because when they sell the bond to the hedge fund, then they transfer the risk out to those guys. So if I can use the analogy, now I'm stretching the analogy, I could sell this bond for $6.50 to a bank, right? He would be willing to buy 8, but it's really $8. He's not gonna bother dealing with me for $8. 8 million, maybe. $8, no. So what I do is I go to the bank. The bank knows I'm not gonna give, do my bond with him. It's really $8, right? But the bank is happy with that, $8 deal because they do millions and millions of these deals. But now the bank is going to say, you know what? I'll do it for 6. I say, okay, 6. What can I do? I'll do it for 6. You make 50 cents, right? And now what you can do is, well, now you have this bond. Now you sell the bond to him. He's willing to pay up to 8, right? But of course not that bond and million of other bonds. Now you buy those millions of other bonds, and now the bank, you sell them to him for 6? No, 7. What happens when you sell it to 7 for him? You can say, but wait a minute, you could only pay 6.5. Well, that was before, when you take the risk. If you sell the risk to him, your regulatory capital now decreases. You see? That's a more realistic example of that. And that's why most of the, many of the trading partners of banks are hedge funds. And a lot of the mortgages that banks give us, they end up selling to the hedge funds.
So it's kind of a symbiotic relationship. It's not so competitive.
Okay, so now we're talking about the financial sector. This is very interesting because this is how it works. Banks and hedge funds could compete, but sometimes they can trade with each other, and sometimes your best not your commercial division, but your prime brokerage division, for example, he's your best client. So you make a lot of money on his trades when he's doing something else, trading stocks through you. So the financial system is very complicated and large and contains lots of transactions. Here, today, we're focusing only on the credit slice of that. Next week, we'll talk about the investment slice of that. In the first half of the course, we talk about the options and derivatives and market sides of that. And we haven't talked about credit cards, we haven't talked about ATM fees, we haven't talked about lots of other things, which is also part of the financial system, payment systems, right? When you look at the entire payment system, then you have this relationship between all the different players. Today, we're just focusing on credit. I gave that example of the traded bond because I think it's very good. It helps you understand regulation and competition. And now with your question, I can say, well, in practice, small deals go through the bank, big deals go to the hedge funds. But the big deals come from banks. And that's how the growth of the mortgage market in the decade of the years 2000 was precisely because of that. The banks were giving mortgages and they figured out a way to sell them to hedge funds who bought them by the hundreds of millions, right? And then I was happy with my mortgage. The bank was happy because they were making easy money, selling it to the hedge funds who then said, this is great. And then the hedge funds were trading them. And then, well, then risks happened. And then the first big blow up in 2007 were two hedge funds by UBS. They blew up, right? And why? What do they have on their books? Very likely this kinds of stuff. But that's how trading works. My objective in that example is that you understand the $1.90 some cents and the $1.50 surcharge. That's the important. These are the important numbers to understand. The $8.06 and the $1.47 that he charges. From there, you understand the whole financial system. Yeah. It's caricature, simple caricature. Today is all about caricatures because it's the only way I can cover all that ground. And now wait for this. This is going to be a caricature too. Okay. Now there was another question by you, right? About the quiz, yes. Tell me. Because you can still finish the quiz today, right? Yeah. Okay.
So it was an option and the underlying asset was a stock.
Yeah.
It was 70.
I love that question. It's such a good question.
We were just wondering if this option has an expiry.
No. Perpetual. Perpetual. Yeah. Keep thinking. Yeah. I'm not going to say anything. I really want you to think about that. It's a great question. It's a great question. All right. Any other? I really don't want to help you very much with this, you or anybody else. I want you to think about that. You will learn a lot after, whether you get it or not, you will learn a lot after you do it. Of course, you may lose 5 points, but that's a different issue. Okay? More questions? Someone was asking me a question about assignment number 2, but that I will do at the end of class today, because then you're prepared to do assignment number 2 very well. Okay? All right, so back to my commercial model. Credit matrix is the one that I want to talk about. It's been around for a long time. And as with everything today, it's going to be a caricature. What I'm presenting to you is a caricature of what it is. It's driven by bond ratings. It's very similar to the credit. It's actually based on the credit rating system that we saw last week with A, AAA, AA, all of that. Credit events are defaults and downgrades. In fact, a default is really a downgrade it's a downgrade to D, which is default. And so it's not, it goes beyond the default risk that we studied at the beginning of last week. Migrations, credit migrations that arose in the first half of today is what it's also taken into account. And each instrument will be valued using the credit spread for each rating class. So back to credit spreads of last week. That's how credit matrix works. And recovery rates are really done by historical similarities. There's nothing deep done with recovery rates in the credit matrix model. something very important as part of the credit matrix is very much a business model consistent with what I told you that the credit rating agencies do, which is they sell you stuff. They sell you a Markov chain. That's what they do. And with the Markov chain, you have your transition probability matrix. You have the identification of the credit counterparty on that, and also a database that I will show you today how it's used. There's a certain database of certain time series, which I'll explain in an example that I'm going to do here in front of your eyes. And it does not integrate market risk and credit risk. In commercial, professional implementations of this, some people do that, take into account the credit and the market, because that gives you the complete risk picture of your transactions, of your portfolio. Credit matrix does not do that. This is very difficult to do, and another reason to hire mathematicians to do that. I have the best way to explain through a bond transaction that I have here. I want to explain here a bond transaction. A certain bond, let's say, is double B. The bond today has, well, these are the value. We're not too interested in the coupon payments or maturity or anything like that. We just want to know that the value of that bond is $102.02. And this tells you an idea what would happen, say, a year from now. Again, we don't assume interest rates will change between now and next year. So in that case, if I get downgraded, my bond will change. The bond I have in my portfolio will change from a 102 to 98. I lose a lot of money. If I get degraded even more, it will lose even more. And if I default, there you go. And my recovery rate is going to be 51%. I'm going to have a loss of about $50. Of course, I can have a credit upgrade, which means that my bond could get upgraded, and then I don't lose. I don't make either, but I don't lose. And the whole statistics that I'm going to be dealing with in credit matrix are the statistics that are summarized in tables like this. This could be the statistic, I have the mean, the standard deviation that I can do. This is the statistic that I can do with one bond, but if I have a whole portfolio, it's just the addition of these. At this point, this model is linear. And it works the same whether I have a bond, a swap, options, it doesn't matter. Whatever I have, I just add on to this. And this gives me the statistical description of what happens with one counterparty. So with one counterparty, this gives me all the information I need to draw my statistical picture of my portfolio, and from there, I can do credit exposures, I can do probabilities of default, I can do loss given default, all of that. That's how credit metric does it. Now, the difficulty in this approach is dealing with correlations. What happens when I have more than one counterparty? And that I'm going to explain with one example. Let's say that I have two counterparties. One is DuPont. This is the plastics manufacturer in the United States. And the other one is Allianz, a very well-known, very large insurance group in Germany. Okay? So the way I'm supposed to do this is the following. I'm given by the company, this is a commercial product. You pay and they give you stuff, right? Some of what they give me is they give me some indices. 152 country indices, 20 indices, sovereign indices, and then 19 worldwide indices that include, in our case, there's 3 indices that are going to be relevant for us. It includes a certain index of equity returns. This is very interesting. For the spreads, we use bonds, but for correlations, we use equity returns. So it contains equity returns for the US chemical industry, the German insurance index, and the German banking index. Okay, why is that important? Because when I take the daily return numbers of my DuPont stock, what I see is that regressed against this database given to me by Credit Matrix, I see that the first stock has a beta of 90% to the US chemical index, and then nothing, just noise. Noise are represented by this variable here. And when I do the regression of Allianz, what I have is, for example, 74% beta to the German insurance index plus a 10% beta to the German banking index. Okay, and noise. So this I can do is a regression of the return of these companies, which is public, the daily return in the stock exchange, which is public, and the indices sold to me by Credit Matrix. And then from there, what I do, this is very interesting. What I do is I calculate the default correlation between my two counterparties. They have to be counterparties with publicly traded stock prices. As the following: the product of the betas times this. Listen to this. It's the default correlation between two indices: the German insurance index and the US chemical index. Now, what does that mean? Indices don't default. What is that correlation index? That is a matrix also given to me by them. So the concept of index correlation here is not to be understood in the financial sense, but in the data scientific sense. It's just a math number. They just give me the matrix. How did they do that matrix? I don't know, but I pay for that. I buy it. A commercial model. If you work for Credit Matrix, if you're hired by them, then your job may be to actually update this matrix on a daily basis, and then you will know how they do it. Okay? And then, of course, the other beta, other multiplication times the same thing. It's the correlation of these two indices that do not default. Yes?
Why there is a 0.15 on the second part of the...
Oh, no, that's a mistake. That's 0.1. 0.1. Sorry, 0.1. So you are the one who asked me for the PDF. Now you see why I'll give it to you later today, because I have some mistakes. This PDF will be available on the website tonight. I need to correct some mistakes. I just finished it. As you will see, this is different from what was on the website. I think it's a little bit better. It was old. I wanted to make something new, and I made something new for today. But still, I saw some mistakes. I'll fix them, and then you have the PDF. Okay. The content is the same as what you already have. There's really nothing new here. Okay, but I removed some old stuff, which I don't want to talk about. It makes me nervous when I talk about some of that old stuff. I need to make it new. Okay? And that's how it's done. And the answer is 11%. And then you ask a million questions, and I have no answers. You say, oh, what's the magic of that matrix? I don't know. What does the correlation between the stocks have anything? I don't know. What do you want? I don't know. I don't know. Okay? But with the correlation number, I can now calculate stuff, just like we did in the first half of today. I used two correlated coins, and we could calculate credit risk profiles for commercial mortgages, for the Goodrich swap and stuff like that. That's the key. Now that we have that, we can do it, right? So this is good. This information, whether it's right or wrong, is good. It allows me to move forward and implement everything we did earlier, but in a very, very different, in a very commercial sense. Because now what I'm dealing with M counterparties. I could have 1 million counterparties. A typical bank could have 1 million counterparties, right? Its counterparty is in a number of states, could be N, 8, 16, which allows me to do everything like what we did for the commercial mortgage calculation with the correlation. I can do the same, except the number of states back there was 4, and here is N to the power M states. What is N to the power M states? N is 8 or more, maybe 16, right? And M is about 1 million, right? So how big a computer do you need for that simulation? Very, very big, very big. So I didn't say this is easy. In fact, there are commercial companies that do this for you. They hire people like you so you can actually do this, which is science fiction, right? You have to start making assumptions and blah, 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 but you can do something. Now this is infinity. This number is infinity. So now you're doing simulation in a space of dimension infinity. Can you simulate a space of dimension infinity? Yes, you can. Yes, you can. But then it becomes a different course. Right? So that's a peak we see, we're going to turn. We're not going to claim that peak. Okay? Understand? Right. their multivariate distribution is given by the marginal distributions as we did here, and the correlations as we just calculated earlier with that magical formula. And I have no answers to any questions you may ask. That's how it's done. Very hard too. Billions and billions and billions of dimensions. Yeah.
It seems kind of like, I don't know, at the beginning of the course you were talking about how you can somehow use some like quantum mechanical formalism to do this.
Yeah.
Is there something like that here? Like,
Oh,
it seems like when you have
I'm sure.
This is like the point of statistical mechanics.
Absolutely, absolutely. Yeah. I mean, these big dimensions we're dealing with here, people who do statistical physics, like they do this every day.
Yeah.
Right. It's nothing. Yeah. Yeah.
Do they use similar methods in the finance sector?
I would not be surprised that they do. I don't know. I've never done this myself commercially, but I would not be surprised. The people who would I mean, I know some of my friends, they work in doing these kinds of simulations. These are the people who will simulate anything. They will simulate polymers, they will simulate this, they will simulate, it's all the same thing. Right? Yeah, so the science that goes into this, the same science that goes into simulating other objects, are even more complicated. I mean, there are people who do statistical mechanics of stars, atom by atom, right? Yeah, they do that in the physics department, in the math departments. They do that. So this is at that level, right? But now I don't want this to become a course in statistical physics now. I just want to show you that peak is there. You see it? Yeah, okay, great. Let's move on. Got it? Okay, so it's a very, very interesting area, but we'll just leave it there. And not only that, when you do simulations, we care about losses which are infrequent. So the damning thing about this when you do simulations is that most of the simulations that you do are a waste of time. If you're trying to simulate 99% events, or with 99% confidence interval, that means that for every 100 simulations, only one works. Only one gives you valid information. So this is very difficult. This is very, very, very difficult. This is mathematically, computationally, from a practical perspective, this is the most difficult thing we have seen in the entire course. This. Okay?
More difficult than stochastic differential equation.
Yes, because you don't have an equation. When you don't have an equation, poof, then, right? At least there you have an equation, but this is much more difficult than that. This is the most difficult thing in this course from a technical perspective. But we saw it, and are we, how can I say, are we scared by this? No, you already did the commercial mortgage earlier, which is only 4, but it's the same. If you can do 4, you can do infinite. No? Yes? Well, that's what mathematicians do. They learn to go from 1 to 2, from 2 to 4, from 4 to infinity. Right? We're at that stage there. Okay, let me move on. This is all I wanted to say about this. Yes, it does not integrate market and credit, so there you go, no problem. And this is the part that I want to spend more time on. This is the other model, which is really interesting. I only have 20 minutes left, and I really want to do it in 10 minutes, because I want to spend 10 minutes on your assignment number 2, which I'm happy to spend more time next week. And this is the Merton model. Now, Merton, in 1974, did something remarkable. I mentioned this briefly when I talked about Black-Scholes theory, but what he did is this. He said, what is default, really? Forget about those numbers, probabilities. What is default? This is very Merton-like. This is the way he thinks about things. So you have a company. The company has assets and liabilities. Assets is what's yours. Liabilities is what you owe, right? Okay, what about equity? What is equity? Equity is what's left. Equity is what's left. But it's not fair to say that equity is the difference between assets and liabilities. Why not? Because when assets are less than liabilities, equity is not negative. Shareholders can always bankrupt the company for free. Right? So his argument is that equity is a call option on the assets of the company with the liabilities as the strike price. Yeah. It's shocking. This is Merton, only, I'll repeat. I repeat, equity is a call option on the assets of the company with the liabilities as the strike price. Why? Because if the assets of the firm are below the liabilities, I said, I don't want it. If they're above the liability, yeah, I want it. That's a call option, right? A genius. Because if that's what it is, that is going to redefine everything we have done in this course. I can start from the beginning, and that's what I'm going to do. I'm going to summarize this entire course of today and last week in 10 minutes with the Merton model. From a completely different perspective. Genius, yeah? It's fantastic. So let me do it. Equity, debt. The value of the firm is what's left. Never negative, right? So default occurs when the debt is higher than the value of the assets, and then they bankrupt the company. Option on the assets, that's what the equity is. That's his thesis, 1974. By the way, he was after the option pricing so he could do this, right? Great, okay, so debt and equity, very quickly. The value of a firm, the equity is that, a call option. That's the payoff. And we know how to price that with the Black-Scholes theory. What is a bond? A bond is the difference. In other words, a bond is, if these are my asset values, the equity is a call option and the bond is a put option. A short put option. A bond is a short put according to him. Right? A short put option is you collect the premium, you're short the option, and then when a default happens, then you lose a lot of money. That's exactly right. So this is his perspective on that. If I have the Black-Scholes theory applied to this, but now note, when we did Black-Scholes, the underlying was the stock. Now the underlying is the asset. The stock is the option. So an option on a stock now would be a second derivative, right? A derivative on a derivative, right? Okay, so if that's my price of the, if that's the price, the Black-Scholes, I showed you the formula, the Black-Scholes formula for a call option when we did Black-Scholes, and I advanced you that we will use that formula only once. The once is now. And I only need it for the call option. I don't need it for put options because I'm pricing the equity according to the Black-Scholes model. Sorry, according to the Merton model. So there's some numbers which are here. This is the cumulative distribution function of the Gaussian. That's the risk-free rate of return. That's the value of the liabilities. That's the value of the assets of the firm. And this is just elements that happen in the calculation of the Black-Scholes formula. We saw it a couple of weeks ago, right? I advanced you where we're going to use that, and we're using it now. Now, but when I use it now, it's very interesting. Everything takes now a different meaning. For example, what is that? That's the value of the liabilities discounted to today over the value of the asset. That's what is called leverage in accounting terms. What is this I have here? That's the volatility of my company scaled over time. But that's the volatility of my company, meaning what? The volatility of the stock? No, it's the volatility of the assets. It's the asset volatility, and the asset volatility is not observed. This is a problem with the Merton model, which can be solved. We just need to be a little bit careful because this number I have here is the asset volatility, not the stock volatility. And the way to do that is you look at the hedge ratio, which is what relates the option to the underlying, in this case the equity, to the assets. And this allows me to write an expression which is what the volatility between the volatility of the stock and the assets need to satisfy. There has to be this relationship between the volatility of the equity and the volatility of the assets. You can check it either from implied volatility from option prices in the market or by looking at historical observations. This I don't. The quarterly statements of my company doesn't give me really a very good picture of what that is because it changes too often. The values, assets, the asset value changes too often. So how can I do this? How can I do this? Well, what I do is this. I note that this is the same as that. And now everything here is a function of the volatility of the assets. Everything in the right-hand side is a function of the volatility of the assets, which means that what I have here is a fixed point. Is a fixed point. And I'm going to show you how to calculate it, because this is how you do it. I have here a calculator, an option calculator. This is the one from John Hall's website, Derivagem. And then what I do is I have an example. I'm going to use this for Goodrich. You will see why. I take the stock price to be a certain number. What is the stock price? The value of the assets, right? And then I take the certain volatility of the assets, which I don't know. That's my unknown. I don't know what that number is. I don't know. And then I have the risk-free rate of return per year. So what I do is I run it, and then I get a value of the option. The value of the option should be the value of the equity that I observe for Goodrich. And typically I see that it doesn't satisfy this equation. But it doesn't satisfy this equation. You probably have seen fixed points in your life. And you know that one way to get fixed points is just iterate until you converge. Well, that's exactly what we're doing. So I run my option calculator, and I can see that the value of the assets I get is not what I should get. No problem. What I do is I plug it back in there, and then I keep trying until I get the same thing. And then finally I get the same thing. I see that the volatility of my assets, the volatility of the equity for Goodrich is 50%. The volatility of the assets is 14.77%. Why? Because that's the number that makes this whole option calculator reproduce the output to be the same as the input, a fixed point. Okay? Great. So with that, I now can do the asset volatility. It took a little bit longer than we thought, because it's not something you can just measure with the statistics. You have to get an option calculator. And now we can go here and we can price debt. And when I price debt, this is again the formula I get pricing the debt from the Black-Scholes equation. You just trust me, right? Which is the same as saying that. And this is a miracle. We're seeing two miracles now. This is the first one. Because according to the Black-Scholes theory, what I have here is the value of my bond relative to my risk-free rate, or relative to my risk-free pricing of my liabilities, is equal to that stuff, which in the Black-Scholes context is the probability of exercising my call, which is the same as the probability of no default. Remember when we saw the sovereign risk example, that we saw that the credit spread was related to the probability of solvency? Remember that? Remember that? We saw it last week. Remember that? It's the same. It's the same. I told you, we're recovering everything we did with the Merton model. That's the first miracle. That, which is the exponential of the credit spread, is, by the Black-Scholes theory, the probability of exercising the call, which is probability of no default. And now you may say, what about that term? You know what that term is? That's an adjustment for the recovery. Because the Merton model comes with stochastic recovery, doesn't it? What's the value of the debt? I don't know. Depends on the value of the assets. What's the recovery rate? Well, give me the value of the assets, the value of the debt, I take the division, and that's what it is. But it's built into the model. The Merton model has the stochastic recovery built into it. You see that? Because I have a stochastic model for the assets and a stochastic model for everything else. The difference, that's what the recovery will be. Because it's built into it, I get a formula which is better than the one we saw last week, because it has stochastic recovery built into it. Miracle number one. Clear? Miracle number two. When I look at the expected credit loss, is the difference between the risk-free and the risky asset. I do some manipulation and I end up with that formula. You trust me. Don't bother to understand this formula. It's not worth it. Okay? You recognize this cumulative distribution of the Gaussian. You recognize the value of the assets, liabilities, blah, blah, blah. And the miracle here is that that number is the probability of not exercising the call, which is the probability of default. That is the present value of the face value of the bond, which is the notional. And this whole thing is another way of expressing the stochastic recovery nature of my model. This is what we saw earlier this morning when I said that the expected loss was the default process times the credit exposure times the loss given default. Remember that? Well, this is here given to me by the Black-Scholes theory. Built in. Okay? Built in. Now, this is very useful because with this, I can build, now this is the KMV model. The KMV model is a commercial, very simplified version of this, which is the one I want you to use for assignment number 2. And now I'm going to talk about assignment number 2. If this represents the evolution of the assets of my firm, and I have here the liabilities, default will happen when the assets end up here. That's my stochastic model, right? Right? If my assets end up here, I don't have default. And if the assets end up here, if this graph, this path, if this random walk ends up here, I have default. And the recovery rate will be what? Well, the difference. That's what it says. And then you can say, well, if that's what it is, then I can write everything in a Gaussian way, and I can do things like this. Let's look at this example. This is the example I want you to know. This is an example from the FRM exam, the year 2000. Let me just read it to you. The KMV model generates an estimated default frequency, probability, based on the distance between the current value of the assets and the book value of the liabilities. That's what I'm talking about. Now, suppose you have a firm that has assets of $500 million and liabilities of $300 million. Let's say that the asset volatility is equal to, what did I say here? It's 100 million. Now, this isn't the problem. For your assignment, no one is giving that to you. You have to do it, solving the fixed point theorem. Okay? But that number is there. And once you have that number, it says here, assuming a standard metal model, where's the approximate default frequency for this firm? I don't need to look at bond spreads, nothing like that. What I do is I just do this. I look at my assets minus liabilities divided by sigma. The number is 2. I look at the cumulative distribution of the Gaussian at 2, ends up being 2.3%. That's the default probability of my firm according to the Merton model. And that's it. The only thing you have to work hard to get is the asset volatility. You get the asset volatility by using the Black-Scholes formula and publicly available information about the company, like the leverage, number of assets, stuff like that. So now I can tell you what your assignment number 2 is going to be. I'll explain it now. I'll explain it again next week and the week after, and especially the last week of classes when I will be teaching communication skills. And then I'll tell you how you can put all of that into a single page, because your assignment number 2 is 1 page. So you have to pick a company. Bell Canada, TD Bank, you pick. That a company, not a province, a company. A publicly traded company in Canada. It's easier, right? You have to get the yield of that company, the yield curve, and the yield curve of the Bank of Canada, risk-free meaning credit risk-free rate of Canada. That difference, we already know from last week, is going to be linked to the probability of default. So that already gives you a probability of default for that firm. But with the Merton model, you have another way of doing that. And I want you to give me the probability of default over time, not one day, not in a year, but over time. By the way, the Merton model over time is exactly the same because we never specified a year. Everything is written as a function of spreads or bond prices or stuff like that. The stochastic recovery is built in, so is time. So both will give you curves, and the curves will be different. The curves will be different. You're going to obtain from the credit matrix model, you're going to obtain one curve over time. And for the Merton model, you obtain a different curve. Your assignment is going to be to give me both, explain how you did it, tell me why the difference, and all in one page. as if you're making a presentation to the CEO of your firm, and you have 3 minutes to do it. I'll give you a mock-up that will be going to you. I have a mock-up, you can see it. That'll be going to you by on Canvas today. How's that? Oh, I still have 6 minutes. You are the worldwide experts now on credit. You know more than 99.9% of the world population. Probably more. Yeah? This is an area where it's still very actively hired. But there's one thing I did not say about credit, and I remind you the second business example that I mentioned here, the one with Scotiabank and the supermarket in Chile. That's where a lot of the credit is done today. But that is really not part of a course in finance. That's really a course in data science. But with everything you learned here, if you know a little bit of data science, you are also very well equipped for that. So the part about credit, which is very contemporary and I am not doing, is the part that hopefully you, with your courses in machine learning and data science, are already prepared to do. The finance you were missing, the finance you have here. Yes? This puts an end to my discussion on credit. See you next week.